In this video, we'll be talking about the path going forward. First of all, let's take a look at the future outlook. Keep in mind this is my personal opinion, so take it with a grain of salt. For a pandemic, hopefully it would end soon. With all the vaccine news from the different healthcare companies in the States, and also China announcing that they also are working on a phase 3 trial. So hopefully it will end by end of this year, if not next year. Government stimulus, however, I do expect them to continue as Congress is working on another $1 trillion stimulus bill. And it's because they already signed on to the idea that they have to save everyone, where government has to make up for the shortfall of any economic downturn. But the problem is government cannot produce any additional demand. What happens is they just take resources from one area and they reallocate it. And so that's just artificial demand. And what happens is in the midst of it, part of that resources goes into the government administration, which is fairly costly. So I expect the massive budget deficit to continue as spending increases and tax revenue decreases. And finally, we're looking into an inflationary period, which will accompany by what I'm expecting a US dollar crisis, where the US dollar loses its reserve currency status, where money printing by definition is inflation. It just happens with the lag, with the multiplier effect and velocity, but velocity gets stored up when everyone's kind of cooped up in their homes, and once they realize, or once the virus passes, they can get back out and start spending. What could happen is the consumer prices will start rising sharply due to not only the increase of money supply, but also with the production restrictions. And so you've already seen some prices rising, like meat. So given the future outlook that, in my opinion, I thought I would go ahead and talk about the different classes of assets, which are bonds, US equities, foreign equities, commodities. I kind of separate out precious metals as it kind of has its own, it's kind of its time to shine for now. Real estate and also for foreign currency. So let's talk about bonds. So I just pulled up this picture from US Treasury yields from Bloomberg today. And as you can see from the yields column, you can see that even with the 30-year US Treasuries, the yield is below the Fed's targeted 2% inflation rate. This is something called a return-free risk, where you are guaranteed to lose money if you are holding it to maturity. So you might ask, why in the world would someone buy something that they're guaranteed to lose money if they're held to maturity? And the key is most of the people who are buying these bonds right now are not expecting to generate income from it, where they're trying to generate capital gain. Because what happens is as the rates goes lower, the bond prices, existing ones, actually go up. But the thing is, the Fed has already pushed interest rates to 0, and Powell has mentioned multiple times that he is not interested in going into negative. So this means they're taking a bet that either real rates are going to negative, or Fed turns around and say, hey, you know what, we're going to do it, we'll go negative. And if anything, the Fed has already promised that they will buy any treasuries. So in a sense, the Fed is backing them up to go gamble with US treasuries. And if the bet goes wrong, well, the Fed will bail you out. So this is kind of speculative, like very, very speculative. And in my opinion, I would not go into bonds right now because for that reason. Corporate bonds, so obviously a lot of the corporate bonds base their yield on the US Treasury. So if the US Treasury is already at a real negative rate, that means the corporate bonds premium from the risk-free rate, like supposedly risk-free rate, is not sufficient. And then also the default risk. A lot of these companies are highly leveraged and they have a high chance of not coming back as their revenue has practically disappeared while they're still overly leveraged from years and years of equity buyback by going into debt because the interest rate has been held to zero by the Fed for so long. So they're able to take on more debt, buy back equity, and then give management gets their stock options really with really high value because the stock prices keep going up because there's less shares out in the market, but it also makes the company a lot more risky. So a lot of these companies who have are struggling to repay their debts, they're only surviving because the interest rates are so low. They're generally known as the zombie companies. So next up, let's talk about US equities. So right now, the tech trade is the most crowded trade right now. So as you can see from after the March crash, NASDAQ was the first one to recover beyond its pre-crash level. And that's mainly driven by the FANG stocks who have just been doing phenomenal. But the question is, yes, I agree that they would probably be here for like the next 5-10 years. But the question is then, yes, if their profits are still going, like obviously Amazon and Netflix are doing pretty well throughout the whole thing. But the question is about valuation. Their PE ratios right now are so high. And this is including other stocks as well. Meaning the US equities are already super overvalued. And other than the FANG stocks, other companies are not generating much income. Well, I guess we'll see about today's Tesla earnings call. So quite interesting. And then next, for sectors that are in question, financials. I don't understand why they aren't going lower. I guess the most recent earnings report came out that they actually had increased earnings, but most of that is actually from their fixed income trading division, which but it makes you think, if rates are near zero, how are they generating income from fixed income trading? It's because of interest rates going lower and they're generating capital gain from those fixed incomes. And if rates are already at zero, meaning that additional income that they have is just a one-time deal. In the meantime, there are other areas like banking, credit card, and trading. They're actually taking a significant reduction in revenue. And that's also why you see they have increased their loan provision because they realize that a lot of their customers are in risk of going default on their loan. So that's why they're trying to make up more provision for that. Home builders. Home builders, this one is quite interesting, where no one is really looking for real estate right now, other than people who are moving away from cities. I'm expecting more real estate will become available in the future times as people are unable to repay their mortgage, and obviously foreclosure, but that takes a while, like a year to a year and a half. But that means with a lot more real estate supply, the home builders would not be doing very well. Healthcare, like obviously the companies who's working on the vaccine, if um, maybe like one or two of them gets it first, maybe they'll do really well. But at the same time, I'm not sure what Congress is willing to do in terms of pricing. They probably don't want these companies to be charging too much of a price, so therefore the profits are probably not as good as the investors are expecting it to be. Finally, oil. Um, the US shale oil sector, the average cost for a barrel of oil is between 40 to 50 bucks, where Russia and OPEC can produce for much cheaper. And that's because of the over leverage in these companies, and they only survive and they were only able to come to life as interest rates are so low. And so the question is, I'm still expecting a lot of consolidation in that space as oil prices have yet to recover above the 40, like $50 level. Obviously, it's above 40 right now. So, and with pandemic continuing, I'm not sure how long until the oil prices would actually recover. So taking a longer horizon look into the future for foreign equities, I'm expecting China's stock market index to outperform other countries' stock market index for the next decade. That's because as US loses its reserve currency status and China's recent massive growth and the fact that China is actually going to developing countries and making them deals as in help them build infrastructures in exchange for natural resources and completely phasing out the US dollar. Obviously, China currently is still the largest holder of US treasuries, which is something they have to deal with. They'll have to take a massive write down, but what they're trying to do is try to slowly trim their position. So instead of dumping it right away, because that would hurt a lot more in terms of the massive write down. But if they can sell it bit by bit by bit, then maybe the pain won't be so big. For India, definitely a lot of infrastructure opportunities there. However, I'm not too familiar with that area. Canada is going to be very interesting. I think Canada is going to take a demand reduction as US loses its ability to buy as much, but Canada could possibly sell more to Asia, Europe, and another thing is Canada is full of resources like precious metal and oil and also uranium, so that can definitely help re-spark the whole economy. Africa and South America is definitely interesting areas going forward, as they're pretty much the only parts of the world where they're still developing, meaning you can expect the really high growth returns, but one thing to keep in mind of is definitely any political risk. Next up, let's look at commodities. For agriculture, as the first group, there's currently US drought and China flood. This is going to have immense impact on the agriculture production for this year, where the corn, you've already seen a massive run up in corn and soybean prices, and along with meat prices, but meat prices mostly due to the production facilities restrictions due to the pandemic. And now let's talk about base metals. So base metal is really interesting, where something like copper, base metals is really used for mainly in developing countries. So like infrastructure, and that's something I'm not expecting anytime soon, but rather when the economy begins recovering. And possibly in areas like Africa, should be able to drive up the demand on these base metals. Oil and energy, again, this is really tricky. Oil, as the pandemic still has not passed, the demand for oil is still remains low, and OPEC is still not cutting enough supply to push the prices higher. And as summer is passing, the highest oil usage season is in this year has really been destroyed, and so all the stored up oil, unless China can restart quickly enough, but they just have the virus restarting again, so that's really tricky. We'll see how that goes. Natural gas is really interesting in this case, as natural gas is usually a byproduct of oil, if all the oil wells are being forced to shut down as there's no place to store them, then the natural gas is also not being pumped out as much. So we could see a big shortage on that area, but we'll have to see, as demand is definitely still reduced. And finally, uranium. Uranium is really interesting as a nuclear energy commodity, where I think it accounts for 13% of the United States energy consumption. And from the recent price action, from $25 in March, it's back up to about 32 right now. Uranium is definitely something that could be as one of the intermediate solution as we move away from the fossil fuels into more green energy. But at the same time, like solar panels, wind and hydro, those are not as developed yet, where uranium is, it produces a lot more and it's available right now. So now let's talk about precious metals. For gold, someone made some jokes about, maybe it'll be 2020 in terms of US dollar per ounce by end of 2020. The stage is really set for gold to the point where like the big banks, who are usually the people who are in the futures market shorting the metal, is now saying that gold will do well. This is all like a lot of investors are thinking like, oh, maybe it's just like a safe haven trade, like because of the pandemic and the second pandemic is over, people are going to flock out of it. But a lot of investors who are going into the space right now isn't really there because of safe haven, but rather the continuous efforts of global central banks in devaluing different currency. So if you think about gold as something constant, if your currency is decreasing by the rate of, let's say, Fed's expectation of inflation of 2%, then comparing to holding cash at negative 2%, holding gold, maybe your storage fee is like 1%. So in effect, you should be gaining 1% from your gold instead of holding cash. Obviously, you can buy treasuries, gives you a little bit of higher yield, even though it's still negative real yield, but that's assuming inflation is only going to be 2%, which, I don't think it will be. It's going to rise sharply, in my opinion. The COMEX open interest for gold contracts are like 600K. So this means like there are a lot of buyers for these future contracts, and the banks are now losing the ability to press the prices down and also the open interest. So this means there could be a big spike up in prices if a lot of these contracts are asking to be delivered, as no one is able to get much physical right now, as that's why the physical premium is much higher than the spot prices. as a lot of mine closures and a lot of big recent demands. And in terms of silver, in past precious metal bull markets, it tends to outperform gold, but it lags. And that's kind of what we've been seeing for like the past 4 days. As I just looked at it today, silver for the past 4 trading days has risen over 20%. So this is definitely something pretty interesting and scary to me at the moment. Not sure how much longer it has to run before a pullback. David Brady is suggesting within a week or two on his Twitter post. He's a really good technical analysis, so maybe we'll see that. And he's saying that the next pullback would be the last best buying opportunity. So definitely keep that in mind. And finally, other than the monetary aspect of it, for industrial, for silver, if we're moving into a more renewable energy era, silver is actually used a lot in solar panels and for other renewable energy appliances. Finally, let's talk about the miners quickly. Obviously, there are the seniors, the intermediates and juniors, and also royalties. So these companies have actually outperformed the US stock market year to date as they provide enormous leverage from the increasing precious metal prices. But definitely something to keep in mind is this: any miners would be a speculation. So don't get into a miner for mining company unless you are really confident in what you're doing. Next, let's talk about real estate. So real estate for commercial, this is really, I really don't see very good outlook for the commercial space in real estate, as the biggest renters are the retailers, and they're part of the ones that are struggling the most. Also, like the hotel industry. And as they are in trouble and possibly going bankrupt, well, some of them already have, the holders of these real estate, either REIT or bank or etc., they're going to have to take a loss on that loan if the lender or the borrower is going bankrupt. Now let's take a look at residential. Residential actually is going to be quite tricky because I think it depends on the area, as a lot of people are moving away from the cities, like some of them to obviously avoid crowdedness for the pandemic, and also they're realizing, hey, I'm actually still working, and if I can work remotely 100% instead of living in like New York or like Vancouver, Toronto, I can move out to the countryside, have either obviously bigger houses, much cheaper pricing, but I can still maintain my job. Obviously, you have companies like Facebook saying, hey, if you're living remotely, working remotely 100%, we're going to take a pay cut. So we'll see how that goes. And another tricky part is the baby boomers' pressure to sell, as more baby boomers are currently at their retirement age, and going forward for I think it's 5-10 years. A lot of them have part of their life savings in home equity. But the problem is with the pension funds potentially blowing up here, as underfunded pension funds are unable to provide the pension income that these baby boomers were expecting. And if the stock market crashes here, there's a high chance of them feeling the pressure to sell and get whatever they can out of their home equity, as other sources of income disappears. So that will push even more supply into the market, causing it to have an even more downward pressure on prices. And if that happens, the lower prices go, more of them will have the pressure to sell. So it's a really it's a bad cycle. And finally, the biggest mortgages are in the city, and that's where if a lot of people are losing the ability to repay their mortgage, then once the mortgage forbearance ends, fine. What happens is they could run into the problem of foreclosure. Obviously, foreclosure takes a while. It's a long process, like 1.5 years. So the massive supply of real estate properties we might not see until maybe a year from now, but the pressure is pretty high in terms of the bigger cities. Finally, let's take a look at foreign currency. So as mentioned before, for US dollar, I'm expecting it to really take a dive here. It might not be this continuous downward pattern as US dollar index is looking at 95 today. It could see a rebound once it tests like maybe 80 or so. But in terms of like long term, like outlook wise, I'm expecting it to go much, much lower as foreign countries do not want to deal with the inflation that US central bank is doing. And also when US dollar loses its reserve currency status, that's kind of pretty much that's game over. Chinese RMB is tricky because as China is growing massively, the currency itself is being put into, it's being forced up while the government's trying to push it down. Government wants the Chinese government wants to keep the RMB relatively lower, so it could continue to export a lot of products. But that is going to be really tricky going forward. So we'll see how that goes. The Hong Kong dollar currently is still pegged with the US dollar, but as the US dollar experience any troubles, I'm not sure how that would impact the Hong Kong dollar. Maybe if it can peg to the Chinese RMB, maybe that will save it from going down with the US dollar. Japanese yen, treat it as like a safe haven. Again, Bank of Japan is printing a lot of money as well to try to help its economy, but it has been doing for many years. One of the difference for Japan is comparing to the US in terms of why Japan actually experiences a deflation, even though it has a lot of money printing, and Bank of Japan doesn't only buy bonds, it even goes into equities ETFs, is because Japan citizens actually save a lot of their money, even if it's in a negative yielding environment. So, and also with the population aging issue, a lot of the different factors have caused Japan to experience massive deflation like throughout the years. So pretty interesting. Finally, euro. The EU is definitely having its own issues right now, as the euro as a currency has a massive moral hazard, as different countries, let's say like different parties have incentives to try to spend a lot more but rely on everyone else to keep the euro status up. That's why you see Germany working really hard in production, even though it's in a negative yielding environment. It's still able to provide positive GDP growth, while countries like Greece are just spending way too much, not saving enough.